This is the Alhambra Investments Weekly Market Pulse, where we talk about some of the interesting things we saw last week. One of the most interesting things from the previous week was the JOLTS report. And Joe Calhoun, CEO of Alhambra Investments, is here. Joe, tell us what the JOLTS report is and what you saw concerning jobs and wages.
Well, the JOLTS report is a job openings and labor turnover survey, I think it is. I guess it's a survey anyway. What it is it gives you an idea of how many job openings there are, which I think they get from looking at advertisements. But it also tells you about two other things that we use to kind of figure out what's going on in the labor market, which is the quits rate, which is the percentage of people in the workforce that quit their jobs, and the number of hires. So you can take all those things and put them together, and you end up with a result that looks a lot like the employment report that we get on a monthly basis, but it's just a kind of a confirmation. Unfortunately, it's a month behind, so we were looking at April numbers. But it's just a stunning kind of thing here in a lot of ways. We have 9 million job openings in this country. In April, that was up a million, almost a million from the previous month. It is an all-time record. There are lots of jobs out there. There may or may not be a lack of qualified people to fill them, but we know that there are a lot of job openings. But we also know that hires was not anywhere close to that. So we've got this gap between job openings and hiring. And so I thought it was kind of interesting, though. The most interesting part of the report was the quits rate, which also went way up. Now, look, all the press was citing this thing from, it was up from 1.6% last year, but I don't know, last April, nobody was quitting their job. Everybody was just happy to have one. So that's not a good comparison. But if you go back to January, we're still up 17%, or no, over 20% since February. So that's a big, big jump. And so I got to thinking about it. I was like, well, what are these people doing? They're quitting their jobs. They're obviously not getting hired. So they quit their job without having another one, which is really kind of odd. The quits rate and the hires rate usually are kind of coordinated. So you see people quitting one job when they've got another one already lined up. Or obviously, if they're quitting a job without having another one, they're pretty confident they can get one. But that's not really what's going on. What's going on here is that people are starting businesses. I also did some digging and discovered that new business applications started to go up last June, and they are up huge. We're seeing these big numbers. 500,000 businesses started in the month of April. A similar number, slightly less number in March, but people are starting businesses. And I just find it really interesting that the economy is changing in ways that we nobody expected this stuff. I mean, if you ask somebody last April or last May, hey, do you think we're going to get a big surge in new businesses? Well, I don't think anybody would have said yes. I know I certainly wouldn't have, but that's what we've got. And I think that this virus got people to thinking about a lot of things. Their quality of life and, what do they really want to do? Do they want to work for somebody else? Do they want to work for themselves? And I think working from home convinced a lot of people that, hey, you know what? I can do this on my own. There was also a big surge, though, in what the Census Bureau calls high propensity job or company applications, new business applications. High propensity new business applications are ones where they have indicated they're going to have employees. There's also a big surge in those. So this is not just a bunch of people quitting their job and becoming a consultant, which is code for I lost my job. So that's not what it is. It's people actually starting businesses. And you know what? I think it's a great thing. Part of the, I think, issue with the so-called secular stagnation of the last decade was a lack of dynamism in the economy. Jeff Snyder's identified a monetary piece of this puzzle, but I think there's more to it than that. And so now we get this new piece where people are starting a lot of businesses. I think it's going to be really interesting to see how this comes out in the end. It could be something that has a huge impact on our economy. But, it's also, you have to remember that a lot of new businesses don't make it. Most of them don't thrive, and a whole bunch of them fail. And it's a tough gig starting a business. Believe me, I know. I've started one. I started more than one. So we'll see how it all comes out. I just find it really interesting how people are responding to what's happened to them over the last year.
Hey, talk to me about the dollar. Looks like it's going to go higher, and I think that's the reason that we've been making some changes in our portfolio. So what are you seeing?
Well, I'm not a big fan of trying to predict the future, mostly because I'm not very good at it. But we do pay attention to momentum, and it's interesting to me that the dollar index fell down to the low end of that range it's been in for 6 years. It fell there in January and bounced very hard, had a nice rally, and then it failed again. We went back down to that level, and frankly, it just seems like it doesn't want to go any lower. And the downside momentum has waned, and now it's starting to turn higher. Why exactly that is kind of hard to say. You can't get in the minds of all the people that are buying the dollar and what they're buying with those dollars. But I suspect that, or in fact, I know there is a yield difference. There's higher yields in the United States than there are in Europe and in Asia, in most parts of Asia anyway, developed markets. And I think there's some buying going on there where foreign entities are buying U.S. dollars to buy treasuries or corporate bonds or whatever the case may be. I mean, yields in big parts of Europe are still negative. So there's yield advantage, and I think that's what we're seeing. But it has an impact on our asset allocation. If the dollar is not going to get in a downtrend, then we have to start to temper our bets that it is. We have been in a weak dollar kind of posture since last April because the dollar did hit a peak and it fell about 15% of it. It was a nice fall. But we reduced our commodity exposure. We still maintain our gold exposure as we would normally do, but we did reduce our general commodity exposure because if the dollar's not going to get in a downtrend, commodities are more of a trading vehicle. You can't just stay long commodities. It's not like it's not like stocks or bonds where you can just buy them and hold them. Commodities have to be traded. Unless you're in a significant downtrend or a very defined downtrend or a very defined uptrend in the dollar, in which case, if you're in a defined downtrend, you can stay long commodities for quite a while because they will trend higher. Same thing in the opposite direction. If you've got a very strong uptrend in the dollar, commodities are not going anywhere. You can pretty much ignore them. Right now, we're kind of stuck in the middle where the dollar just keeps going up and down in this range. And so you have to try to kind of play the ranges. Well, we're at the bottom of the range. We feel like you reduce your commodity exposure, let the dollar go higher, maybe get an opportunity to buy them back at a cheaper price. We also have raised some cash on the equity side. Equities are very expensive. We think we're in kind of a little transition period here. We're not sure. Look, bond yields have fallen, which is an indication of falling nominal growth expectations. We've seen inflation expectations fall and growth expectations fall. That worries us a little bit. Stocks are very, very expensive. And I think really what we're doing here is we're transitioning from we had this expectation we were going to get a boom coming out of COVID after everybody gets vaccinated. And I think it's dawning on people now that it may not happen. We saw in the consumer sentiment survey, which was better, current conditions was good, expectations were higher. But if you dig down in the details, there were some interesting pieces there. Expectations or anticipation of buying, I don't know exactly how they word it, but essentially the anticipation of buying a house or durable goods over the next 3 months, a car, a washing machine, whatever the case may be, all those things went down pretty precipitously. I think part of that is price. Prices of those things have gone up. Part of it is a lack of supply. It's hard to find you can't get a used car right now. And part of it is I think that people spent a lot on goods over the last year, and now they're looking to spend some money on travel and so forth. But I think you're going to see a rise in that leisure spending, and you're going to see a fall off in goods spending. I think people are having to adjust their idea of what economic growth is going to be going forward, and I think it's going to be lower than what they were expecting. So we kind of expect to see stocks pull in a little bit here too. We have seen a waning momentum in the S&P 500, and other indexes like the NASDAQ and the Russell 2000 have been stalled for about 2-3 months now. We did also reduce our REIT exposure somewhat. We had a huge run with REITs, and we keep a bigger allocation to REITs than most shops do. So our REIT allocation for a moderate account, for instance, had gotten up to about 20% of the portfolio, which was too high for us. We trimmed that back to target, so we just took some profits there. So we're acting a little more defensively here, Bob. We think things are probably due for some kind of pause.